Okay, the next problem on our list is CP8.3. CP8.3 has a lot of calculations in it, or a lot of journal entries that we have to write down. So I've written a few of them up there to speed things along. It says J&A recently hired a new creative director. In order to entice that creative director to move, they advanced him $100,000 on April 30th, 2012 on a 1-year 10% note with interest payments required on October 31st, 2012 and April 30th, 2013. J&A issues quarterly financial statements on March 31st, June 30th, September 30th, and December 31st. In this instance, it wants us to do journal entries for just about every date that we have here. The first step, part 1, says prepare the required journal entry that J&A will make when they actually issue the note. This one's fairly straightforward. It's probably the simplest one we have in this problem. We are going to debit notes receivable to establish the note, right? We actually establish the notes receivable and we'll credit the cash because we're providing them cash. And one of our other problems that we had here, we instead traded notes receivable and accounts receivable, right? In this instance, we're instead loaning out money. So we're giving money to entice the person to move and actually come work for them. Debit notes receivable, credit cash. Part 2 says make the adjusting journal entries required at each one of the quarters, and then also the journal entries required when they actually receive cash. Well, for this, we actually have to calculate our interest accrual, right? So I've written out for you the various dates, just so that you know how this is laid out. I've got quarters, I've got this little mark, hopefully you can see it there. But I've got this little mark when we have a quarter in. Here's where we actually receive a cash payment, quarter in, and a cash payment, okay? So first step to do is to record the adjusting journal entry for the quarter in. If we look, on April 30th is when we actually establish the note. So from then we just have to count how many months have passed since we've earned interest, right? So April 30th is the same as May 1st, so we've got May and then all of June, right? So we've earned 2 months worth of interest. Our journal entry is going to be debit interest receivable and credit interest revenue. Now, how do I know that we're not getting cash yet in this instance? Well, it tells us we only received cash twice during the life of this note, right? Once on October 31st, once on April 30th, 2013. So I know we're not getting cash, but we have the right to receive cash. Why? Time has passed. This person has borrowed our money. They're paying rent on our money, or they owe us rent, and they'll pay us on October, right? So how much do they need to pay us? Well, we've counted that 2 months have passed. We've talked about in class and in previous problems that the rates that they provide, unless we're told otherwise, is an annual rate, right? Well, we know that we calculate interest taking the principal times the rate times time, right? That's our calculation for interest. So I've written for you out these amounts that you need to know. Principal is $100,000, rates 10%. The term is 1 year, but we're concerned with the months within this period, right? So I've got for you 100,000 times 10% equals 10,000. If you take that 10,000, which is an annual interest, right, and multiply it by the time that's passed, 2/12 or 1/6, you should get an amount of 1,666.67 here, okay? Same on both the debit and credit side. That's the amount that we've earned of interest so far. So we record that for interest revenue and an interest receivable because we have the right to receive that amount. The next date that comes in is September 30th. 3 months later, this is again a quarter in. Remember, quarter in is when they produce their financial statements. In order to make their financial statements accurate, they have to do the adjusting journal entries. Why? Think about people outside of the company, right? So if you're inside the company, you know that time has passed. You've let this new employee borrow this money, right? And that they're going to pay you back and you've earned interest because time's passed. But if someone else is investing in your company, they don't have the inside scoop. They're not working there day in, day out. They have no idea what you have earned or what you're supposed to be receiving unless you tell them. And how do you tell them? Via the journal entries, which shows up on the financial statements. They can then read those financial statements and say, hey, they've earned an additional 3 months of interest, right? So if we look again, I said 3 months because time has now passed. June 30th is the same as July 1st, right? So we have July, August, September. 3 months have now passed. Using again the same calculation, the 10,000 now times 3/12 or 1/4, we should get an amount of 2,500. Again, we have not received cash yet because I have listed out here when you will receive cash. Debit interest receivable because we have the right to receive cash, in this instance 2,500. Credit interest revenue because we've earned the interest, $2,500. All right, next month that comes up. This is October when we actually receive money, right? They told us we receive money 2 times during the note's life. This is one of them. In between September, which is essentially September 30th, essentially October 1st, right? We have 1 month of time that's passed. So we've earned 1 additional month of revenue, interest revenue. All right, since we're getting cash at this point, we know we're obviously debiting cash. So we can go ahead, just debit cash, right? How much? Well, the note's life is 1 year, right? These payment dates are 6 months apart, right? So we've received 6/12 now is what we're going to get for cash. 6/12 or 1/2 or 50%, right? That's how much we're going to get for cash. If we know that the total amount that we should be receiving for the interest for 1 year is $10,000 and we're getting half now, we're getting $5,000. So this is how much cash we actually receive, right? But we have to get rid of some of these other journal entries that we made in the past, and we have to record one more account. If we look, we've been saying that we have the right to receive these 2 cashes, right? These 2 receivables that should turn into cash. So we have to get rid of them. Credit interest receivable to reduce them, because now we've received the cash. We've been saying we have the right to receive the cash. Now we've got the cash. So we credit interest receivable for the total amount of that, which is 4166.67. And then our journal entry still doesn't balance. The difference goes to interest revenue. Why? It's that additional month. That 1 month between September 30th and October 31st, we've earned an additional month of revenue, right? And that's the calculation I have written out here. If you take the 10,000 times the 1/12, right, you're going to get the additional month of revenue, which should be 833.33. Now, you could simply just take the difference too, and that should equal out as well, right? And you could just use this as a plug. But this is how you actually calculate it out. For these next few journal entries, the journal entries are exact same. All you have to do is look at what we've done in the past and then repeat it. In December 31st, 2012, we have a new quarter in, right? Well, let's look. Between October 31st, which is essentially November 1st, and December 31st, 2012, 2 months have passed, right? So we take 2 12s and multiply it by the 10,000. We get the 1,666, same as what we did for the first journal entry where it was 2 months have also passed. If we look over here for March, sorry, this is getting, a lot of journal entries written around here, but the date we're looking at here is March 31st, 2013. We have another quarter in, right? So we establish again from December through March that 3 months have passed. Same thing here, 3 12s, 3 months have passed, 1/4, right? We multiply this out by the 10,000, and again we get 2,500. 2,500 is how much that we've earned as time has passed. Now, on April 30th, 2013, we get another cash payment. Again, this cash payment is going to be the exact same as what we had here. We would have debited cash, our 5,000. It's our second half, right? We said that we earned 5,000, or we received 5,000 on October 31st. Now we receive the other half. We credit our interest receivable, the amount that we said we had the right to receive, right? So we're adding up the 2,500, adding up the 1,666, and we get 4166.67. And then we credit interest revenue for the difference, which is the same amount as we had last time, 3.3. Because again, 1 month has passed. If you look, March 31st, same as April 1st, right? And now we're making a journal entry again on April 30th, 2013. The last part, part 3. Part 3 asks us, prepare the journal entry that J&A will make to record the principal payment at maturity date. This is pretty much straightforward. We finally get our principal back, so we're debiting cash. The original amount of the principal all the way up here when we originally recorded it right was 100,000. And now we reduce the notes receivable 100,000. Because we no longer have the right to receive it. We just got the principal back. All right. I know there's a lot of journal entries in this problem, but if you break them down like this and look at what's happening at each date, whether it's a quarter in or a cash payment, do not be confused. When you earn interest revenue, that does not necessarily mean you get cash. You have to look at the contract when it determines when you actually receive cash, right? But if you break them down, you'll notice that the journal entries start repeating themselves, right? Pretty straightforward. The reason why we do these adjusting journal entries is so our financial statements are on an accrual basis, so that a user can look and say, oh, you guys have earned more interest revenue and you have the right to receive that cash, right, based upon interest receivable that you're establishing. Don't forget, interest receivable, this is a balance sheet account. So every time you record something right here, it sticks around until you remove it, right? It sticks around. So in this instance, on June 30th, 2012, you recorded interest receivable of $1,006, right? Well, then on 9/30/2012, when you recorded another interest receivable, $2,500, these two are added together to show the receivable balance. That's why on October 31st, 2012, we credit interest receivable for this total amount, because we're getting rid of these balances that we established. They just keep adding up on the balance sheet until we remove them, okay? So that a user can look and say, this is the total amount that they should be receiving for the interest they've earned, all right? So this is CP8.3. If you have any questions, please feel free to email me and let me know.